Hey guys, what is up? My name is Arthur9 and today I would like to share with you my 5 tips that I think you should know if you would like to get started investing in the stock market and make money on the long term in a sound and stress-free way, because that's what I've been doing and these are the tips that I found really helpful in doing just that. If that's something you are interested in, I highly recommend watching this video till the very end because I believe it is full of valuable information, and hopefully by the end of this video you will have a better understanding of what kind of approach has the possibility to give you safe and stress-free returns if you are looking to invest long term. I will go over these tips one by one and I will show you how I applied them to my case and why they could work very well for an investor who is looking for safe growth and wealth building. By the way guys, these tips helped me make almost 50% return on my investments within just one single year of investing. That's like putting in $15,000 into the giant stock machine and 1 year later being able to take out $22,000 if you would like to, which is just pretty insane to think about. And if you would like to give stock market investing a go, I would just like to be here providing you with the tools so you can give it your best shot. I have 2 announcements to make before we jump into these tips. The first one is that it's a bit of a disclaimer. This video was intended to be uploaded on the 11th of February 2021 because that was the date that officially marked that I spent 1 year investing in the stock market, and up until that point I think I reached about 44% return total. So it's not exactly 50%, sorry about that. 50% just sounds better in the thumbnail. I hope you don't mind. I hope it's not that clickbaity, but there is that. The other thing is a massive shout out to the 9 people who already subscribed to this channel. I wonder if we can make it 10 with this video because that would be pretty awesome. Anyway, here are the tips that you came for. My first tip is to buy low and sell high. What this principle or tip would like to tell you is that ideally you would like to purchase your shares when it's the cheapest and you would like to sell when it's the highest so you can pocket the biggest possible difference. Although it is a really good principle and the basis of much of the wealth created in the stock market, you would be right to ask, okay Arthur, but how do I know when it's the cheapest? And to answer that, I would need you to understand there is this different way of thinking between average emotionally led investors who would just sell whenever they see a falling market and red numbers and that they are losing money. And on the other side, investors who can detach themselves more or less from these emotions and make their own decisions based on analysis and their own evaluation. And so here's the catch. Whenever you want to buy in at the lowest price, that would mean you are buying into a falling market that you don't really know when will rebound. As Warren Buffett, one of the greatest value investors of all time, summarizes this problem that I've been just talking about: be fearful when others are greedy and be greedy when others are fearful. That's how this opposite way of thinking works and how you could make good money on the stock market if you're in it for the long term. Now, if you ever worry about investing in a falling market, be sure to make your way to the 4th tip in this video because I'll be sharing some really good advice on that problem. My personal example for this tip would be March 2020, when this whole situation we are currently living in was unfolding. And long story short, I did my research and I came to the conclusion that the combination of media and the people kind of overreacted the situation. This is not to say the situation wasn't serious. I just thought that the sell-off in the market was way bigger than what it should have been, as some of these companies lost 30, 40, 50, even 60% of their valuation, and I didn't think they wouldn't be able to adjust to a new environment. So I thought and I believe these companies became somewhat undervalued and I was actively looking to invest. Which leads me to my second point, that is, invest in what you understand. Because that principle will be the guarantee that you are getting yourself into a fair game. That's why I would recommend reading articles and books about how money and the economy works in general. You see, I study economics at the university and I have learned about quantitative easing, or in other terms, that's when the money printer goes brrrr. And I have that advantage over other people that I know printing money is a good tool to boost the economy in the short run. The first news came on the 12th of March, I believe, that the Fed is willing to print money and boost the economy this way, which I actually missed, so I was not aware of those news. So I took a leap of faith and bought my first stocks on the 23rd of March. And the news came when the stock market closed that day. The Fed is ready to print money. And so I thought to myself that whatever I had prepared was probably now was the time that I should invest that. And the very next day, the Fed indeed started printing money, and came the news that the stock market was indeed rallying. By the way, these are the stocks that I picked, that I was familiar with, how much I paid for them, and what they would be worth nowadays. I still own the very exact shares of Google and MasterCard, but this is not investment advice. It is a 1-year-old story anyways, so why would anyone invest based on that? But there you go. By the way, guys, I put in a lot of effort into these videos, so if you find any value in them, please give it a thumbs up, because it really goes a long way and really helps me out. Thank you, and now enjoy the rest of the video. Now that you know when to invest, comes the question with what exactly do you invest? And so tip number 3 is invest money you are ready to lose. This principle would suggest building an emergency fund first and investing only after that's done. An emergency fund would cover 3 to preferably 6 months of living expenses just in case something comes up. You would put that money in a high interest savings account so it's readily usable when the unexpected happens, acting for you as kind of a safety net. And if you think you're missing out on something by creating your emergency fund first, I found an interesting article that talks about a recent Bankrate survey that found that more than 60% of Americans wouldn't be able to cover an unexpected bill of $1,000 without some of them going into debt. So by building your emergency fund first, you will be doing better than 60% of Americans, which I think is the best return and result you can ask from your money. So this emergency fund step is likely the best one to set you up for success, because the money you have over your emergency fund can go into investing, and you will feel much better about that money investing it, because what's the worst case that can happen? You lose the money you were ready to lose, but what's the best thing? You just make more money. So it's pretty good, and it lets you invest stress-free, which I think is a huge thing in today's world. I mentioned it earlier in this video that the next tip will be very valuable, so please allow me to deliver. Tip number 4 is buy and hold. Now this principle is a very good argument when it comes to the question of what happens if I invest in a downward trending market. If you take a look at this infograph, it shows you alternating periods of green and red based on historic stock market data. Now the green area will be your bull market when the prices are increasing and you can gain on your positions, and the red ones will be the bear markets when the prices drop and you lose the value of your investments. The interesting thing is in the top half, in the box containing the facts. We can see that based on the data available, that the average bull market lasts about 4.5 years and prices see increases of 150%, while on the other hand bear markets last just for 1 year and prices see a decrease of 30%. What this means is that you could statistically on average invest in the stock market in a company and you would see your money grow if you give it a long enough time. Now during that time, obviously a lot of things can change around a company. In the most extreme case, they can even go bankrupt. And so if you would like to avoid the hassle of picking individual companies and re-evaluating your decisions every now and then, it is recommended and is generally a good practice to look into the S&P 500. Now, what the S&P 500 is nothing more than a giant basket of companies, namely containing the 500 biggest US companies that all operate in different fields of the economy. So let's say you have $100 you want to invest, and for example, in this case, into the S&P 500 ETF, ticker symbol SPY, if you would like to look it up later. So once you decide to invest your $100 will be spread across these 500 companies accordingly to their sizes. That would give you the benefit of diversification as these companies are involved in different sectors. And thanks to that, not all your eggs will be in one basket. So if one industry does poorly, you have all the other industries to compensate for it, reducing your potential losses. Partly thanks to this great diversification, the S&P 500 has been able to return somewhere around 6, 7, 8% per year after inflation, which is a pretty good return if you ask me, compared to little to no work involved on your part. And my last and final tip for this video will be tip number 5, dividends matter. If you take a look at this graph, you can see that almost half of the historical S&P 500 return was due to dividends reinvested. Now, if you don't know what dividends are, I made a separate video about explaining stock market details right here. So if you need some help, go ahead and check it out. I personally love dividends. I have this approach that net worth is cool, but cash flow is king. So whenever I have cash flow coming in the forms of dividends, I always get to choose what I want to use it for. I can, of course, reinvest it and buy more shares that will give me more dividends so I can buy more shares again. Or I can use it as income, pay some bills, or it just gives me a peace of mind that whatever I do, I still earn money, so I have to work less and less, and I'm being financially more independent as I build my passive income in the forms of dividends. If you really manage to stack up your dividends, it might be enough to actually retire early and completely live off dividends. Or if you would just like to supplement your retirement income, that's also a viable option. But talking about retirement, make sure to open a Roth IRA and max it out every year so that whenever you retire at the age of 59 and a half, you would get that money in there tax-free. So these would be my 5 tips that I think you as a beginner investor should know before getting started investing in the stock market. Let me know which one you like best and which one actually surprised you and you hadn't thought about up until this point. I hope you learned something new today. If you did, or you enjoyed the video, if you found any value in it, please give it a thumbs up because it really helps me out. And also consider subscribing because I will upload a lot more videos connected to the topic of wealth building. As always, thank you guys so much for watching, and until next time.